So yeah, so now we're live. We should have participants coming in. And yeah, we can just get going. I'll wait for a few people. Looks like they're slowly filtering in. So everyone, welcome to the Marcus Hour. We have just been chit-chatting here about some life lessons actually. And we're happy to have you join us. So now we're going to get into some other lessons on another topic. We're very excited for today's session. It's a different kind of format than our typical question and answer for the Marcus Hour. This is the third installment, and we decided to kind of focus on a very exciting and topical issue that's been going on, not just in associations, but pretty much across the nation. A big topic. And what we're going to be talking about as it relates to associations is how you can protect your association funds. And this is in light of Silicon Valley Bank, First Republic, and Credit Suisse, who for background, regulators seized the banks in early March. So we're gonna kind of give some tips on how you can safeguard your assets, prophylactically protect against a crisis of this nature. These are rare, but they're important to look out for and important to protect your funds wherever possible. So just a disclaimer, as this is the Marcus Hour, so it's usually Stephen Marcus and I, attorneys, not financial advisors. We also have a special guest who is a VP of HOA Relationship Manager for City National Bank. We're really excited to have him along. Just as a general disclaimer, this is general guidance. Everything should be looked at on a case-by-case basis. You should look into, a CPA and your professionals that you work with directly to look at the exact specifications for your needs and your association.
And to just put an exclamation point on that, for these webinars, which are general advice and not based on specific circumstances, we are not acting as your attorneys. No attorney-client privilege or attorney-client arrangement is being created, nor is the banking advice and the legal advice something to be relied upon without going to your own trusted advisors, whether they be lawyers, bankers, or CPAs or insurance agents. Jake?
Yeah, absolutely. So yeah, everything is on a case-by-case basis. And yeah, I'm gonna do a share screen. So we're gonna get into a PowerPoint presentation. That's just us. You've seen us before if you've been on our program. On the left is Stephen, on the right is me. It's a clock on the bottom. And yeah, so we're really excited to bring along a special guest, the first special guest for the Marcus Hour, Maurice Achi. Am I pronouncing that correctly, Maurice? Last name?
Yes.
Okay.
Yes, Achi.
Achi, okay. And he's the Vice President, HOA Relationship Manager for commercial banking, deals with association banking, has a great expertise in these areas. City National Bank, just for some background, they offer financial solutions, and Maurice works directly with condos and property managers. City National Bank has plenty of lending and treasury solutions, but today we're kind of get into deposit solutions. For example, you'll hear a lot about ICS, CDARS, all the acronyms you can name, Intrify, and we'll get into those today. And we'll get into some of Maurice's specialties, but as I said, he's well versed in this topic, which is very, very important today, and he'll be able to talk on some of those aspects. Now, City National Bank and Maurice are based in Florida. We obviously deal with, we do have a Florida presence, but we deal with a lot of New England states, Maine, Massachusetts, Rhode Island, New Hampshire. I think something just to note there, that Florida with a lot of condo and association issues is generally at the forefront of what kind of follows nationwide. And that's no different today. That's no different in the past couple months, few months, actually years. And will continue to be that way. And when I say that, I mean, on the financial side of things, there's a lot of things happening in Florida on the insurance side, and as far as reserve requirements at associations that are legislatively going to be required by pretty much the end of 2024. And that obviously relates directly to Surfside and the incident with the building collapse on the Champlain Towers. But that doesn't stop the fact that reserve requirements and keeping adequate reserves and the requirements that are going to follow in many jurisdictions will be seen nationwide. And so, yeah, we're excited to have Maurice along because he kind of is seeing it all at right in front of us in plain sight on a day-to-day basis with associations and managers he's working with. So we're excited to have him along, Florida based, but an expert in this topic, and happy to have him to kind of educate Stephen and I as well on this topic. We've been chit-chatting. He stepped up to the plate, and we can't appreciate him enough for taking his time out this Friday morning. So thank you, Maurice.
Thank you very much for having me, guys.
Yeah, and I guess we'll just get into the program. So unless you want to look at Maurice's face the rest of the program.
So well, I'm saying it twice. So so I think I'm doing this slide. So my background going back to March 10th, the day that Silicon Valley Bank was seized by the FDIC. And keep in mind that if you were looking for a day where you don't want to be putting $5 million into a bank, it's probably a Friday. Historically, I'm not guaranteeing this, but banks are seized by the FDIC usually at the end of business day on Friday with Silicon Valley Bank. It was actually in the morning, but two things had happened. 40 billion had been taken out by Peter Thiel's fund, the PayPal and First Zuckerberg investor in Facebook, and then everything goes at the speed of light. So it then got to Twitter. And Maurice tells me that the 40 billion within the 24 hours before seizure became 80 billion of withdrawals from the bank. I got involved on March 10th because I was down at a wedding in Key Largo, and where Jake was part of the wedding party, not the groom though. An attorney friend of theirs, young but very bright, said to me, "Did you hear about Silicon Valley?" I said, "Yeah, of course." And he said, "What do we do about our IALTR accounts?" So in Massachusetts, IALTR account for non-attorneys, IALTR accounts are clients' funds accounts, and the state regulates them through the Mass Board of Bar Overseers and the Mass IALTA Committee. The good news is they were struggling with this as well. So this other attorney and myself were having emails back and forth with the Stephen Casey, the CFO with the Mass IALTA Committee, and they were trying to work their way through what the solutions were as well, going into DIF in Massachusetts and Interfi and other solutions. I only give that as a footnote because the Mass Audit Committee, when it comes to clients' funds account, is very conservative. So we follow in large part a lot of what Mass Audit Committee says. Go to the website, MAIOLTA.org, and you'll see the policy that they posted last week. Going into how much was lost, we talked about the 40 billion to 80 billion of withdrawals prior to the seizure. But at the time of the seizure, the amount of total deposits was $175 billion. And I'm guessing if one of the answers is, well, talk to your trusted bank advisor, I'm guessing if your bank was SVB and you called them the day before the seizure, they would have probably said, we're a great bank, keep your money here, for fears of losing deposits. Maurice informed me that some big banks like Bank of America made some substantial deposits to keep things going with SVB and allowed the government after the seizure on Friday to announce on that Monday that everything was being protected, all funds were being protected. But more than 85% of the deposits were above the FDIC limits of 250,000. There were techs and startups that had $100 million. So there was a substantial amount that either would have been lost or through a bankruptcy-like procedure, maybe over a year or 2 years or 3 years, maybe depositors would have gotten back some of the money that they lost. But very scary. I know that First Citizens took over a bunch of the deposits, and Maurice will know the name, but it was somewhat like the next day it was like the Santa Clara Bank of California was the entity formed by FDIC. Maurice?
If I'm not mistaken, I think you're right on that. I'm not 100% sure, but I think it's something along those lines.
Okay. And Silicon Valley Bank had offices in Massachusetts. For those of you from Massachusetts, First Republic also has offices in Massachusetts. So the question is, you as managers and as board members and as attorneys are dealing with other people's monies. So if you had $1 million between operating and reserves in a bank, and it did not have DIF or IntraFi or lesser known Max Safe as a product, the announcement to unit owners by the board and manager that you had just lost or put at substantial risk $1.75 million with the boards that I've dealt with and unit owners I've dealt with over 40 years. My strong guess is that they would not be happy, and probably the next call was going to be to a law firm to bring actions against the board and the manager and anybody else that is in sight. So obviously, you're dealing with other people's monies, but in light of Silicon Valley Bank, even though we might have learned in 2008 or during the 1990s, but now is the time while things are settling down for you to protect the funds. I can't give you 100% guarantee. I can probably give you an almost 100% guarantee that there are ways of protecting association funds. FDIC insures up to $250,000 per account. For individuals, if you personally, if you husband and wife or have a joint account, $500,000 would be protected, but that's not going to help condominium associations. So what are the possible solutions? Coming from Elizabeth Warren, a senator from Massachusetts, and others, and some big bankers in the area, one solution is the federal government could increase the FDIC limit from $250,000 to $500,000, just like they increased it from $100,000 to $250,000 in 2008. Move that was temporary, but became set at the higher limit. And going back to the Great Depression and the initial insurance in 1933 with FDIC, I believe it insured up to $5,000. So $500,000 and $250,000 are larger amounts, but there's more that could be lost with reserves, and the requirements are going to include structural integrity analysis. If you get an association loan, you can't forget that if you have $1 million drawdown, that there's another $1 million in a bank, and you have to make sure those are protected as well. So first is FDIC increases the limits. The second solution is, let's say you have $2 million. Well, it's per bank. So if you went to 8 banks and had $250,000 and not a penny more in those 8 banks, that would be wonderful and would protect those funds. My concern is that managers and associations really don't want to have 8 banks or 10 banks or 30 banks. When we get to InterFi, Maurice is going to talk a little about how his bank, dealing through one bank, can through InterFi protect per depositor up to $180 million. Other banks do 50 million or 75 million. So having 8 or 10 or 100 bank accounts at different banks, managers are not going to like that, and it doesn't make sense. You could consider a bank which is DIF protected. Now, when I say DIF, that's mass DIF. DIF is also used by FDIC, but that's not what I'm talking about here. The mass DIF started as governmental and then became privatized again. It was formed in 1934, and it claims that it never lost a penny of its depositors' money. It only applies to mass state chartered savings banks, and there are around 70 member banks. What they offer is unlimited protection over $250,000. But what you have to keep in mind is, even though they say they haven't lost a penny in 89 years, during the 1990s, they claimed they had 6,200 depositors, and they salvaged them with $50 million of payments for monies in excess of the $250,000 FDIC limit. And then I looked up how much the fund had, and on one site, actually the one that's linked with the Secretary of State site, said 500 million. And I looked at another site that claims that there's 27 billion in 2022, 27 billion in protection, which sounds incredible. 27 billion, it just seems like an astronomical number. Everybody would be protected, but 27 billion is no longer what it used to be. So going back to what happened with, say, Silicon Valley Bank, I told you that 85% of their 175 billion was in excess of FDIC limits. The amount at risk was 148 billion just with one bank. So by all means, talk to your lawyer and your CPA and your banker as to whether DIF Massachusetts as a private entity could potentially become insolvent and not pay if they have $27 billion and the claims are 100 billion. Talk to your CPA and banker as to whether that's far-fetched and is not likely to happen. There's a great article that talks about DIF insurance, and I think Dina from the office is going to send out the PowerPoint, and then you can click the link. Next slide. The fourth way of protecting funds is through something called InterFi. I'm going to have Maurice speak to InterFi and what it is and how it works and why it may be the just about perfect solution or almost perfect solution for protecting funds over the 250,000 limit for condominium associations. Maurice?
We're having a technical issue with the,
We can't.
give us a second.
Okay. When Maurice is on, he'll continue, but let me just say when I say almost perfect, look at paragraph 2. On InterFi's website, it has the disclaimer, which relates to short-term risks as accounting is made for deposits and withdrawals. What that means is you go to, say, Maurice's bank for a period of time.
I'm back on.
For a period of time, whether it's for a day, overnight, whatever, there's $5 million, and it takes time for the process of the getting spread out over the numerous banks in order to cover all amounts. Same thing with withdrawals. You want to withdraw 5 million, various banks, the 3,000 and that make up InterFi deposit into, say, Maurice's bank. There's a short period of time where, in theory, those funds are at risk. First advice would be don't do the big deposit to open or the big withdrawal on a Friday if you can. But with that filibuster, let me turn it over to the now no longer speechless Maurice.
So thank you very much. I appreciate you guys. So yeah, so in regards to InterFi, right, if you would like to have some kind of peace of mind and convenience that comes with having access to millions of dollars of FDIC insurance through a single bank relationship with solutions that are provided from your bank and through InterFi, such as InterFi Cash Services, ICS, or CEDARS. Those are services that have been utilized by thousands of businesses, government entities, institutional investors across the nation for cash management needs. So in essence, the way this works, so everybody get an understanding on how InterFi works, is so let's use the same dollar figure that the $2 million that you have with the bank for your association. The association would go ahead and deposit them into, in this case, City National Bank. And then we would automatically set up the InterFi shadow account, which is the ICS account, that would allow these funds to then be swept into into a deposit account or CD, depending on the liquidity needs of the entity. Then they will be placed into the 3,000 plus financial institutions that are part of the InterFi network. and put right under the $250,000 of FDIC insurance. Now, I know I get asked this question a lot of times because sometimes you have these funds sitting there. These funds can at some point earn interest that will be set by the participating institution of your choice. So, so if you go to City National Bank and deposit those funds and, you know, want to negotiate an interest rate that can be paid on those funds, then of course, you know, we would be able to have that conversation. Now, when we go in regards to, when it comes to like rates and things of that nature, they're often compared favorably to treasuries or government money market mutual funds that that most people are looking into nowadays, right? But we normally recommend them to put into deposit accounts to avoid the risk of prime rate money market funds. Out there, guys, have any questions? Anything else I should chime in on?
And there's a chat section for whether we get to them today or we do it sometime next week. We'll answer every question that's either posed in the Q&A or the chat.
Yeah.
The only thing I was going to add was that we did have a pre-submitted question at registration from somebody, and the amounts may be low, but it was that $2 million in operating and reserves. So a financially well-heeled association, it would seem that your two options realistically are either to look at Mass Diff, which has the issue of does it have enough funds if there was a big enough failure or several failures, and to probably more likely look at IntraFi, because that 2 million can be spread over 8 banks, or for 3 million, 10 banks, 12 banks. So that's my only add-on. Jake, any questions?
No, I was just gonna say, yeah, if anything pops up during our presentation, you have any questions related to this, tangentially related to this, whatever you kind of can come up with, feel free to use the chat feature. I know it's not as much of a, we're kind of going over one topic, so it's a little more, little less rapid fire than previous sessions where it was Q&A and addressing certain issues, but this gets a little more deep and more detailed. So understand if there's some questions or confusion that you can go ahead and ask.
Okay, perfect. And so right back where I was going to kind of chime in on this in regards to how much of your funds can we secure? At City National Bank, we have the capability to be able to, through the IntraFi network, secure you the funds up to $180 million in your deposits. Now, the beautiful part about
per deposit.
Per depositor, right?
Yep.
Per client, right? And so if you would come in and say, you know, Maurice, I have $5 million, and just kind of give you a little bit of an example, when everything was going on with these banks becoming insolvent and the government taking over and preventing failures, we had close to 1,200 of new accounts being requested to be open and brought over from those banks. So that kind of created this big wave and this big notion around IntraFi and wanting to know more about IntraFi and why wasn't it always offered. And it's one of those services that it's definitely you need to ask your bank if it offers it and how it works and what their coverage maximum is, right? So I just wanted to throw that out there. The other point that I wanted to touch on was just to give everybody a peace of mind was no one has ever lost a penny of FDIC insured funds, ever. So let's just kind of go and say that you have $1 million of operating, because let's not talk about 2 million, let's talk about $1 million between reserves and operating. You have $1 million that you need to deposit into a bank. When you place those funds in ICS or CDRAs, funds are then divided into amounts below the FDIC insurance, a maximum of $250,000. Those smaller amounts are placed in different FDIC participating banks. Now, one of the other main questions that have always been asked is, what about our information? We want to safeguard our information. We don't want our information floating around 15, 20 different banks or 10 different banks. your information is always kept secure. It's managed by by us, and then placed into these other financial institutions that we know who they are. You will actually know them because the record keeping is very transparent, detailed, and simple. You'll receive just one statement, one regular statement for each option utilized. And of course, your confidential information always remains protected because those other banks know that those are funds owned by City National Bank of Florida. And we know that those funds are owned by the different entities that we've placed, the entity that has placed them in our bank. So rest assured that your information is not floating anywhere else. Now, by making these funds eligible for FDIC protection, you guys can eliminate the nonstop hassle of ongoing collateral, no more maintaining multiple bank relationships, having to have 4 or 5 different type of banks, or even I've seen people have up to 10 different banks to have their money spread across and secured because they weren't aware of the IntraFi services and the ICS services provided. So again, like I said, you manage relationship, managing consolidating balances, interest disbursements, or having a footnote of uninsured deposits in your financial statements. You're able to just make things very simple and streamlined for everyone. I know that a lot of times, board members or property managers are trying to, keep everything in order and organized. And we are made aware that it's a lot simpler and a lot easier for everybody to understand and know where everything's at with the transparency of one statement and where your funds are allocated. So that comes to you at the end of every month.
So when I first talked to the Mass Allcock Committee CFO, and again, it was new to everybody. Yesterday I saw our Secretary of State from Massachusetts on telling people, don't worry, the Secretary of State's office, and they have a information sheet, but we're probably actually telling you more information than what they offered. But the 250,000, say in 8 banks, they before the Mass Allcock Committee CFO fully understood it, or maybe he still has the concern as well. What ifs, and attorneys always do what ifs, and what if FDIC says, "Oh, this is a sham. What do you mean it's in 20 separate accounts?" I know the answer of one banker friend to me was, when I expressed concern, is, are you saying what happens if FDIC goes out of business? Followed by, if so, we're all in trouble. We all have bigger problems. Definitely. So to me, the IntraFi product seems to have the advantages over Mass DIF, just in terms of the ability of bearing a substantial loss based on seizures. Let me answer a couple of questions that came up. One was, what Massachusetts institutions are IntraFi? If you go to the IntraFi site, you can search by state for a particular bank. But also keep in mind that in addition to Maurice, there are other out-of-state bankers who offer products, and they'll do them in Massachusetts as well as anywhere else. The second question that I got troubles me much more, which is, and I'm guessing it's not Massachusetts because we require segregated accounts for each association. But the question basically was, well, a manager keeps the funds all in one account for the benefit of the different associations. So let's say there's so there's a couple of problems. Let's say that there's $20 million of funds that the manager is handling. One, is it set up with protections such as through Interfi? But the bigger one is in Massachusetts, you have to do it, but wouldn't associations want to have their own separate accounts, so you don't have to worry about what if there's a seizure and there's only protection for $250,000 of all the $10 million of accounts, even if the FDIC said, well, if each association we'll give 250,000 of protection, but losing control over the funds, in my opinion anyway, is not a great idea. It's rare, but once or twice each year we read of cases across the country, or whether it's the treasurer of the board or the management company or somebody else on the board, where there's misappropriation of funds, and the funds are absconded. And so my answer, which I use way too many words to explain, is have your own bank accounts. Make the manager, ask the manager to set up accounts in your name, for one for reserves and one for operating.
Actually, in Florida,
Well, I'm
Jake?
sorry, Jake, go ahead.
Yeah, I was just
Yeah,
going to say
in
there was a
Florida,
recent issue in Florida of an extreme case of embezzling, but that was, I'm sure you've heard of it, Maurice.
Yeah. So in Florida, we are by law, by statutes, we need to have the funds separated and in the own association's name. So if you have operating, you need to have an operating account that solely those funds are used for the operation and the management of the building. Anything that you have, then you have your reserve account that if funds are going in there, they're allocated in there, that are part of your general the budget that you've passed for reservable items such as structural integrity, electrical, life and safety, and things of that nature. We cannot have them commingled. And even if you have one manager, he should not, well, in Florida, they cannot have all funds from all the associations that manage under one roof. They have to have separate entities for every single one. And allude to what you were saying, Jake, right? You know, that association that you were talking about, right, is currently looking at about $3 million in fraud over the course of years and adding. And then the board members that were caught in all this also are looking at criminal charges and looking at jail time. You know, and so the state's regulators have come in and starting to put in a little bit more stringent rules and regulations into our associations that hold them more accountable and not just protect them so much that they're able to do these unlawful acts to the association and fail their fiduciary responsibility to the association. So yeah, definitely.
I was just going to add to that. When Jake and Maurice talk about embezzlement and crimes and all that, they're talking about alleged embezzlement and alleged crimes. Though maybe being in Florida, they have a suspicion as to what happened. And I got a second question with people asking what banks in Massachusetts a part of the 3,000 members of Interfi. I'm going to give you a tiny bit of homework for the DIF members. If you go to Deposit Insurance Fund Massachusetts, it's going to give a list of the banks. There are about 70. On Interfi, it's a search feature. So you plug in the state, you can plug in the name of the bank, and it will tell you if that bank is a member. But then the thing to remember is the bank does not have to be a Massachusetts bank. So if there are better terms and more familiarity or other lockbox services and other type factors, you're not limited to Massachusetts banks.
Yeah, no, and it is, yeah, it's alleged embezzlement, alleged fraud. But and it's an extreme case as well. But yeah, there's important parameters to just follow generally, and there are, we've discussed this in previous sessions, that boards are under, for board members, trustee members are under, there's a fiduciary duty owed to the unit owners. And that I mean, the money is an important issue that you want to safeguard it, you want to do the right things, and we'll get to more of that in the session. Is there anything else you guys want to discuss?
I was just going to answer the other question. The person says they're not commingled the funds, they're set up as XYZ management company for the benefit of the association. That is, in my opinion, a lot better for purposes of, but though I prefer the accounts being in the name of the association, but for FDIC purposes, the FDIC is going to treat your separate accounts, in my opinion, for the benefit, if they have 30 accounts, but for the benefit of different associations. My understanding of the FDIC rules is they're going to look at each one separately because they have different beneficiaries, but avoid it all by just having the manager put the accounts in the name of the association, so you don't have to lose sleep, or we don't have to argue with the FDIC to see if we're right or not.
And that's
to chime in,
go ahead.
I'm sorry for interrupting, but to chime into that, to that question, right? For the benefit of, when the management company is setting that up, the tax ID that's going to be utilized is essentially the association's tax ID, even if it has because for tax purposes, it will use the tax ID of the association, because when they do tax, associations are non-for-profit. So even though they say the name of, XYZ management company for the benefit of XYZ condominium association, the tax ID number utilized is the association's tax ID, not the management company's.
Or at least,
kind of
or at least it should be.
At least it should be, but that's exactly how it works. Even though the titling says, XYZ management company for the benefit, for FBO, for the benefit of XYZ association, the tax ID associated to that bank account is the tax ID for the association. So to your question, so back to the question, it would be considered as if it's anything up to $250,000 in the that the FDI would insure. Anything north of the $250,000 of that particular tax ID would not be insured, and that's where you would have to go to your financial institution to ask if they offer the IntraFi cash services or the CDRs services, and then that would allow you to spread the funds through FDIC participating financial institutions and under that $250,000 of FDIC insurance. And I hope that kind of answered the question.
So it seems to, based on the response on the taxpayer ID number, they if there were 100 accounts for the benefit of, and there were $250,000 in all of them for the 100 associations, and they all have their own taxpayer ID number. The thinking is that those are covered, but attorneys being attorneys, I'm going to say I'm still a little more comfortable, not for FDIC issues so much as control, that I would put the accounts I wouldn't, if I were the manager, I wouldn't want the accounts in my name for the benefit of, then you're custodian and there are other trustee duties. And I prefer to see
The
the
way,
accounts under the name of each association.
and to your point, that is true, Stephen, because here in Florida, when we bank some of the largest management companies across the U.S. And when they manage an association, the way they have it is the name of the name association, and there's no benefit of. You'll see it's open under each association, and you'll see in the mailing care of the name of the management company and the address of the management company. But at no point do we see across here in City National Bank, I've always seen over the 5,500 plus associations that we manage, you'll never see for the benefit of. You'll always see the name association, care of C/O, the name of the management company, and will be mailed to the management company. We'll disperse it or get it out to the properties individually.
Perfect. Yeah, no, that's a great point. And it seems like some of our participants are agreeing that these are helpful tools and tips to kind of segregate and make sure you kind of ensure every protection you can. That's kind of the goal of this kind of session. And that's just one of the ways that you can make sure you're in compliance. But we can get on.
And just to kind of, and to continue, just to kind of let everyone that's participating on this, at City National Bank, our main focus is to provide advice, guidance, and a perspective to any board, whether it's within the state of Florida or outside of the state of Florida. We'll provide advice and guidance on what should be and what we see as a norm in regards to it. And if anybody has any questions or needs a little bit more in-depth conversation about what they should be doing, please feel free to reach out to Steve and Jake. My information will be shared. You can reach out to me. I always have my phone and I'm available all the time. If you want more information or get a little bit more granular with your individual associations or clients.
Absolutely. And we'll certainly, I mean, if the question is above our heads, we'll relay it to Maurice, and he's been more than helpful with a ton of this. And yeah, property managers as well. He's dealt with managers, he's dealt with associations, trustees, or board members. So any questions you guys have, we can definitely get granular. But we're going to take it, now that we got kind of deep into the weeds, we're going to kind of bring it back to the basics. The question of this whole thing, we've brought it up a bunch so far. What is FDIC? What does it cover? FDIC was created in 1933. As Maurice mentioned, no depositor has lost a penny in FDIC since 1933. And to take it a step further, on the Massachusetts level, any depositor in DIF and FDIC insured accounts, no depositor has lost a penny since inception as well, from 1934. Now, as far as what it covers, savings accounts, checking accounts, now accounts, which is a negotiable orders of withdrawal, savings, money market, retirement accounts. Now, if a bank is FDIC insured, it provides for full insurance for its customers' deposits and accrued interest up to $250,000, no exception. And as Maurice has mentioned, as Stephen has mentioned, nobody has lost a penny. No depositor has lost a penny in FDIC insured accounts since 1933. Now, what does it not cover? Above 250,000. So we're going to get into in a second, and we've kind of touched on it. What happens if your association needs to safeguard more than 250,000? Just for general purposes, doesn't cover stocks and bond investments, mutual funds, annuities, munis or municipal securities, crypto. So you won't be able to invest your Bitcoin or or Dogecoin, and much to the chagrin of Elon Musk. But there are, we'll go back to FDIC in a minute. But we wanted to just touch on this for a moment. SIPC, SIPC, Securities Investor Protection Corporation. We're just going to touch on this for a moment because this is more likely to be used by individuals. This involves, stock, bonds, cash, those types of securities. Not as much used for associations, but we can.
Jake,
go ahead.
and I'm sorry to cut you off. I just wanted to chime in on this. Now, I know you say that it's more used for individuals versus condominium associations. I have seen where some associations would want to put some of their funds into treasuries and things of that nature. Those things are always dictated by the bylaws. The bylaws of your association will tell you if the bylaws allow you to invest those funds into investable assets. Because you can't just say, well, I want treasuries. Well, your bylaws dictate what you can and cannot do. So we would first recommend you to either the board members or the property management company to speak to their counsel and say, well, do our bylaws allow us to invest before you decide to just go ahead and try to invest. But just wanted to piggyback on that, Jake.
Yeah,
and that answers another question. Well, enlightens me, because I was thinking of protection of investors as to their brokers. So Maurice's answer is enlightening, but it leads to another question that was asked. The only other question that was asked pre-registration, which was, can we be a little more daring? And they mentioned FISLIC, which is no longer, but was for savings and loans. It all became part of FDIC.
Right.
But there are some very safe investments with higher returns, especially these days, more than the 0.10 or 0.20 that banks were giving not too long ago, where it's backed by the full faith and credit of the United States government. We won't get into the debt ceiling and whether it should be raised or whether the full faith and credit isn't good enough. We're going to assume that, again, we're all in trouble if it isn't. Somebody asked a question about bail-in where depositors considered unsecured creditors. I had mentioned that after you get your $250,000 FDIC insured, it's sort of like a bankruptcy. So you're in a big line with others if there's a failure. To my knowledge, there's not been a case where for the $250,000 limits where the depositor had to stand in the back of a line. Jake?
Yeah.
And we only have 6 minutes.
Yeah, we can on
45 minutes of materials.
We'll put it on 2x speed, so we'll talk really fast. But yeah, we're going to get into some of the things that Stephen and Maurice just touched on. So what I'm going to discuss next is basically, someone asked, there's a board obligation to maximize profit. And Maurice touched on this very nicely by mentioning the bylaws, because initially I was going to state, it depends on your boards and unit owners' time horizon, risk horizon, but it's very, very important to look at the bylaws, the governing documents, to see what you can even do as far as investments.
And I told Jake that he should tell the listeners to put the monies in their mattress, and he had no idea what I was talking about.
Yeah, that one went over my head a bit, but I get it now.
Yeah, in regards to what you were talking about, right? There is a fiduciary responsibility of the board or the trustees to maximize the return of unused assets for the board. Like I said, the bylaws dictate what that can look like for each individual. Based on the fact that we're in Florida, although we always recommend for our associations to have their monies liquid. You never know an unforeseen need or an emergency or a major catastrophe. Here we're prone to having hurricanes, so we always want to make sure that our clients have access to those funds and liquid in case, you need to mobilize contractors, engineers, and things of that nature, or start doing repairs to the association while you're in the claims process with your insurance provider. Because if you put your funds into any kind of treasuries and you're not as liquid as you thought you were, then you can get penalized for just terminating those treasuries and earlier than they're supposed to, than their maturity. So it's always good to have a conversation around the liquidity needs of the association, how much is the needs from an operating point, what they would like to how much they would like to have liquid in case something should arise. But these are conversations that you need to be having with your trusted advisor, your banker. Like I said, and I repeat this again, at City National, but by providing this, the guidance, the advice, the perspective on what we should look at, we always want to make sure that the client's priorities and what's important to them is at the forefront of everything that we do. So by advising, we would like to, we're adamant about putting it into treasuries. Well, we can structure it into maybe a short-term treasuries and then have other things liquid. So yes, but you always want to look at your association in whole and what would allow it to not to create an obstacle for you to have any repairs or things like that that need to come up happen. So sorry about that. Just wanted to chime in on that.
So Jake, on slide 10, I think that's already been covered.
Okay.
So,
Well, the other part, yeah, if there's a fund that grows, let's say the growth goes above the 250,000 threshold. I know we were discussing this, Steve, before. There's certain things that the association needs to consider. Do we want to go into that for a moment?
Yeah, you could, yeah, absolutely.
So
It's your show.
to your show too.
You're named first. You're the first Marcus.
Yeah, so basically, I mean, if there's a deposit and it starts at 250,000 and it goes, there's some growth upon the deposit above the 250,000, is it still FDIC insured? And what was our conclusion there, Stephen? Or what was some mechanisms that you could use to?
No, once it goes over, you have to set up a different protection system, such as Interfi. And I think we were talking about it going up because of Florida with SB 4D and SB 2D.
Which are insurance bills and reserve requirements, structural inspection.
Requirements.
Yeah.
Which will.
So with those, the results of those reserve studies, which now are broader because they're structural, is that associations, unfortunately, are going to have to be putting more monies into their reserves. And therefore, once you have more monies in the reserves, you can go over the $250,000 limit. And the other concern is if you get a report for 20 or 30 million dollars of repairs and need to get an association loan, that Maurice does, and I know a bunch of folks in Massachusetts and across the country do. You want to make sure that those funds are all protected, presumably by Interfi.
Exactly.
Now there's one thing, Jake, if you don't mind, just because it's 11. There's one thing that's really bothering me. on slide 11. Fidelity insurance. The maybe slide 12 then.
12, yeah. Okay.
So on number 4, so Massachusetts, this is not about FDIC. Massachusetts, we have a requirement that the association maintain fidelity insurance for a quarter of the year's assessments, naming the manager as designated agent and obligor, and it has to be, and it's the association's policy. If it's the manager's policy, the owners of the management company wouldn't be, you wouldn't be protected if the owners of the company took funds. Even though we only require 3 months, if you have $1 million in reserves, and your 3 months was 100,000, my strong suggestion is have fidelity insurance for the full amounts that are on hand, so that now could be the $1.1 million, and then think of the reserve studies and structural integrity studies, boosting the reserve and make sure those funds are protected under the fidelity. And then let's say you go to Maurice and he gives a $20 million loan. You have to make sure now that you can't forget about those funds as being protected outside of FDIC, just with funds that in theory could be stolen by a board member or manager or whatever, as Jake and Maurice were talking about in Florida. I think we're past 11, but what do you want to do, Jake?
We could just run through the last couple of slides and so we had a question: how do we protect funds over $2 million? Every case is specific to your association. It may be unwieldy to put $2 million in funds in 8 FDIC insured accounts, for example, because it would only be $250,000 that you can put in each account. There are options that we've discussed: ICS, CDARS, IntraFi, but you do have to look out, at least for CDARS, certain liquidity and term restrictions. So that will vary.
Exactly.
And yeah, we'll run through this list really quickly. Other areas for protecting your association funds: regularly review your financial statements. It's important, just as a general practice, to kind of always be cognizant of what your financial health is at your association. This could include your reserve study as well. We in a previous session, we sent over kind of the people who do reserve studies, which are as Florida is already requiring them by statute. We anticipate other states will likely follow, and reserves are going to be necessary. And what you do with those reserves is what we kind of have been touching on today. It's just something to really look out for, and another step forward on top of just monitoring the financial statements. Keeping an eye on the expenses. This is important. You want to save for the rainy day fund, the reserve account, but just general expenses. See where the money's going, see where it's being allocated. If you know there's a big capital improvement project, know what you're doing there, know how much you're going to allocate towards it. Change orders are a regular thing we deal with that increase the value of the project. So just a good idea to
price overruns.
What's that?
Cost overruns. So you're projected to, we see that a lot in associations where they have set up a special assessment or budgeted for a project that's going to cost them, from what they see, 15 million. And then as work starts going along, they start coming up with obstacles that change that dollar amount, and they have a cost overrun because they have to take care of that. They sometimes have to come back to the financial institution to see if the financial institution can modify their loan and increase it like an accordion and give them an increase on that dollar amount, or they will have to go into the reserve funds that they have allocated to be able to cover that cost overrun. But then, like, back to what you were saying, Jake, is that if they're going to go ahead and have reserve requirements, by January 1st, 2025, the statute states that you need to be in schedule to meet the reserve requirements for the life expectancy of the certain items, depending on the life expectancy of the certification that has to be done. So, those are things that you definitely have to take into account when you're placing your funds in other financial institutions and how you want to have the maximum return, rate of return on those funds. So just wanted to jump on that, Jake.
Yeah, no, that's a great point. And yeah, and just along the same thrust, keep a good financial procedures, make sure everything's flowing properly. And we already discussed these segregating managers accounts. Fidelity Insurance we went into. It may be a good idea. Bullet point 6, communicate with the owners or liaison to the owners. It could be a good idea to set up like an advisory committee to kind of oversee the financials and expenses and all that. We see sub boards all the time for different purposes. We even see we have seen sub boards for even just to maintain a reserve account. So to take it a step broader, it would be for the financials. Consider cyber crime insurance.
Definitely.
With a hacker, that's not a fun procedure, and it's just something to keep in mind.
A further point on that is what's happening is, one, cybercrime is not covered typically under a master association policy. So you have to buy the coverage, and some coverages are better than others, just like some carriers are better than others. What's happening, and it's affected attorneys as well doing real estate conveyances, is you get information. You're supposed to be wiring, let's say, $1 million of funds to a general contractor for major restoration work being done. People are hacking into the accounts, sending you an email saying the wiring instructions have been changed, please send it here. What happens next? You never see the money, and you have no insurance for it if you don't buy the insurance. The first step, at least that attorneys do, so I suggest managers do the same, is if you get a change of wiring instructions, call up the person that you're sending the funds to verify that the wiring instructions have changed.
Yep.
Right. That's one of those big things you see where you're sending wire. It actually happened to one of our clients in association banking, where they sent out a wire for a large work that was being done in one of the large projects, and the email was intercepted halfway through. The PDF file was then grabbed, the account information and routing numbers were all changed and then put back into the intranet and then sent to the receiving party. When the association and the company, the general contractor, communicated like, oh, we haven't received the funds, they realized that the information has been altered. Thankfully, the association was able to recuperate those funds because they never landed where they needed to land. But it's always important that when you're getting or receiving wire instructions that get sent out, encrypted, because that prevents from anyone grabbing or being able to alter the document.
Yeah, definitely. And yeah, it's sometimes it's literally just a change in an O instead of a 0 when you're sending the wiring instructions. So it's very important to, best practice to confirm by calling, say, hey, you got this, or confirm the email address, confirm the numbers, confirm everything.
Yep.
So
Final slide.
yeah, I just wanted to point out one more thing. This one's a little harder to monitor as far as financials, in light of the regulators seizing banks. Sometimes there are signs, you'll hear in the news, look at the stock price. This is a little harder too, because you can't just look at a stock price and tell, oh, that bank must be going on. So I wouldn't say just look at that and say, okay, I need to remove all my funds from XYZ bank. But it's a good idea to just follow the news as far as your bank, follow potential market volatility with the bank. But that's that one you need to not just kind of immediately assume because your stock price went down $1 that it's done. Just another thing to keep in mind.
And you guys, and
if we're able
just
to, Maurice, perhaps you can send us something about how your bank issues its reports, or give something that we can send out perhaps next week to the registrants for tips just on looking at the strength of the bank. If you have it, great. If you don't have it, that's okay too.
Well, we have our own strength and stability document that we can provide our clients to show where our portfolio is structured and where our assets are. Every financial institution should have that, and if you request it, they are obligated to give it to you, right? So if you want to go into a financial institution and ask for, the strength and stability, they should have a document that tells you, their strength, their how well capitalized they are, where their assets are at, and things of that nature, so you can feel assured. We were proactive. City National Bank was proactive to this when all this was going down with Silicon Valley Bank and First Republic Bank and Credit Suisse. We automatically sent out to all our clients our strength and stability bullet points to address any concerns they may have. Sometimes these are very high level, so these are not financials you deal with on a day-to-day basis. You may want to go to your attorney or your accountant to ask, to kind of like decipher it. But we do provide that, and I can share that with you guys, so you can share with the rest of the attendees, just to see our soundness and stability from a financial institution for City National Bank. One of the things, I'm sorry, go ahead.
I was going to say, that would be great. We're going way over at this point.
I know.
So, Jake, you want to reel us in, or have me do 30 seconds on slide 13?
Yeah, just let's go through the final thoughts on protecting association funds.
Okay, this now goes into insurance. If you have the stated limit insurance policy, say for $50 million, the agent isn't responsible for that, saying that, guaranteeing that's the amount. The carrier isn't responsible. You really should have a licensed insurance reconstruction cost appraiser tell you what the actual value of your building is, or in the alternative, get guaranteed replacement cost coverage, which replace no matter what the cost. Two, we talked about three. A lot of buildings in Florida and in the Northeast are having problems because they're older, and as they get older, the code changes. Typically what happens is if half of the building goes down, you have to rebuild to current code, which might be automatic fire suppression systems, elevators, etc. You want to go to a building code expert to say, if this building went down, a half down, what would it cost to meet current code? You also want insurance to cover demolishing the undamaged part of the building, because the whole structure has to come down, and debris removal. And we're finding that some policies have $300,000 in automatic coverage, and that almost might be worse than not stating any amount, because we're finding that in cases that building ordinance and code could be in the millions as building age. The final point was on lien enforcement actions. I'm not sure what's going to happen with the economy or when collections are going to start steaming up, but take swift action when an owner is a month or two behind. And I guess my final thought as a teaser is the news out of Florida is that there may be some issues with Citizens Insurance, which I think is the state in insurance, almost like the FAIR Plan in Massachusetts. There were remarks made by the governor indicating that that Citizens Insurance either is or could become insolvent. So there's talk about a 45% increase for everybody's premiums who has a policy, a overall like 2% insurance increase for everybody. But when you have to start worrying about bank failures, well, I dealt with that during the early 90s and 2008, and now when I have to worry about insurance companies going out of business, I have never dealt with that, or I don't believe I have. So on that bright note, anything that you want to add as a final tip, Maurice?
It really, one of the things here in Florida is making sure that you are taking care of all the items that are coming with your recertification. We're seeing that a lot of insurance companies that were insuring a lot of our buildings and associations in the state of Florida have pulled out of Florida or are not renewing or are increasing policy premiums by, I've seen one instance that it went up by 150%. And that was because they had not or had deferred the maintenance on their roof. So they were able to get an extension for 6 months on getting their insurance policy renewed for 6 months, but it was in lieu of them having the roof getting repaired, at least permits being pulled and then bids being put out. But yeah, it's just making sure that your board is not deferring any maintenance on the building. Things that are going to impact your insurance are going to be important, and always have a conversation with your insurance agent in regards to what can be done to lower your premiums. But we're seeing this across the entire state, just because of the natural disasters that we have, and then because of the Châtelet Towers was another big one. We're definitely making sure, and when we go into a board, we speak about the importance of not deferring any maintenance and the importance to everybody's pocket, because they're realizing that the cost of living in an association increases as you start deferring maintenance or reserve requirements.
But I want to thank all the participants who, we didn't lose too many. There's still a bunch of you on. I apologize for being long-winded as always, and for going over by 16 minutes, but I'm encouraged that so many of you stayed on. My final thought before I turn it over to Jake for his is I wish you all a happy Passover or a happy Easter, and we will see you in May on the first Friday at 10 a.m. Thank you for attending. Jake?
Yeah, just thanks everyone for attending. We'd like to give a special thanks to Maurice, our first special guest. I mean, we told him, it might be 10 to 15 minutes. He stuck around for an hour 20. So we can't thank you enough, Maurice, and providing really sound
My
insight
pleasure.
to the property.
We might want Maurice on for every call.
If I can listen, I love what I do, and if I can add any value to anyone or provide any advice or some guidance, I am more than glad to join and participate and give my 2 cents about the association banking sector. So if you guys ever need anything, feel free. My contact information is there. I told another attendee that if they needed anything, reach out to me. I'm always available, and I can answer any questions.
And our intent is to send out the PowerPoint. So in addition to everything else we talked about, Jake's contact information, Maurice's and mine are all on there. Maurice, thank you. You're extremely impressive. But I think that comes with, and we have it in the Northeast as well. Banks who, 6 or so banks that really focus on. Typically, we have condominium associations versus HOAs, but I think your advice today was wonderful. And sorry that you had to wake up at 4:15 this morning and go and drive to the office. But thank you.
My pleasure, guys.
Thanks, everyone, and
All right,
have a good holiday weekend.
Likewise, everyone. Happy Easter.
Yeah,
Jake, you want to save the chat?
yeah, got it.
Okay. We still have people on there.
Yeah, no, I'm yeah, well, okay.
I just wanted to thank Maurice privately for doing an excellent job and making something that's scary and perhaps complicated to many simpler and with some